Greetings and welcome once again to another exciting episode on the Dr. Kareem Ainsley Encounter. This is the Dr. Kareem Ainsley Show, in which we're going to be engaging in the financial audit as we engage in financial conversation. Today, the key concept that we want to examine is the ROI. Yes, you heard that right, ROI. What does the ROI mean? Well, the ROI basically is a financial metric. It means return on investment. And this is saying to us that if I invest in something, it means that there needs to be a return on that investment. And that is how the businesses think about it. That's what the CEO, the Chief Financial Officer, thinks about when he is balancing the books, creating the budget, executing the plans for the company to leverage their position. But why is this important to you? It means then that ROI can be translated or transferred into our normal personal finance, which means that anything that we invest, or time or talents or treasure, whatever it is that we invest in, it should be bringing us some reward. It should be bringing us some return on that investment. The ROI is the average of the initial investment that is earned as a result of the investment itself. A high ROI indicates a more successful investment. That would be ROI that is high and it's positive, while you can have a negative ROI or low ROI, which could indicate a failure of that investment to mature. And when your investment fails to mature, it means that you probably are losing money, or you have to wait longer than expected, longer than intended. So, as a normal individual going about your day to day activities, what are some of the things that we have the opportunity to invest in? Well, first of all, there is what we call stocks. These are shares of a company in a publicly traded market. So these are basically publicly traded companies. So the branded names that you see that are on the stock market, that is what you could invest in. If you don't even want to buy the product, but you know that people like the product, and you can see in the future that this product will stay for a long time, then this is an investment opportunity that you as an individual can take onto yourself. But let us not forget about ourselves. We need to invest in ourselves because it is very costly to be in ignorance. So when you lack knowledge and you're operating in ignorance, you make mistakes which you didn't need to make. And that there costs you time, it costs you money, and it costs you other external resources or other external situations that you may not have had to get engaged in. So this is why we're presenting this free information, this free insight for you to position yourself in a state of strength so you can make strategic and wise financial direction. Another thing that we can invest in are bonds. And what are bonds, you may ask? Bonds are basically loans made to a government or a corporation, with the borrower agreeing to pay a fixed rate of interest over a certain amount of time. So bonds are usually given by the government when they are trying to raise money for a company. And this is normal. We don't have any problem with that. Yes, bonds have a lower ROI, but the bonds in some times of the economy, like when there's a high inflation, the ROI on the bonds increases. Next, we have mutual funds. And mutual funds are financial investment vehicle that pool money from many different investors and use it to buy diversified portfolios of stock, bonds, and other securities. Then, one of my favorite ways to invest is that of real estate. Yes, real estate in my mind is the only estate that is actually real. The estate that you can see with your hand, you can liquidate as you see fitting, and you can have a depreciation taking place on an appreciating asset. So if you understand the concept of real estate, you'll realize that the real estate market is actually a strategic position if you understand how to play in that market, and you can get a lot of write-offs when you're in real estate. So let us discuss it. Real estate include investing in residential or commercial properties such as a house or an office building. Yes, investing in these opportunities can position you for now in this moment and also position you in the future. So you can reap the reward, and if not, you can pass on that reward to your children and allow them to accept that upon your passing at a step up cost basis, which means that if you paid $100 for a property and the property values $5 million after you have purchased it over your lifetime, you can pass on that property without the tax implication on a step up basis. So the initial price of the property when you pass it on to your children would be of the final price or the market price at the time of your passing, and they would not have to pay the capital gains on that which would have increased. So this is a way to pass wealth from one generation to another, but we have to understand the key concept. So anything that you get in must have a return on the investment. So you must have a plan for everything. Now, let us move now into commodities. Commodities, these are raw material or basic goods such as oil, gas, wheat, etc., that are traded on the market. And they're used by mostly the farming community and some agricultural agencies. Gas, gold, and these things are also used by some speculators. And these commodities are used to hedge dollars in some regards. They are used to hedge resources that will be needed at a future date. This is a way in which you try to have a stabilized price of goods and services. That way you can more predict over time what the prices are that you'll be paying for a particular good, so you can calculate that in your bottom line instead of dealing with the market volatility and fluctuation. In some cases, this work out for the person who is engaging in this practice. In other situations, when the market dips or the market spikes, it may not be so favorable. But this is a safer way in order to guarantee consistency and reliability. Now we move into another form of investment, which is cryptocurrency, which are digital currencies such as Bitcoin, Ethereum, and these are encrypted techniques used to secure transaction and verify assets. This area is currently in a new speculative phase. The market has increased in 2020, 2021, and then it collapsed in 2022, 2023. It reminds me of the tulip phenomena era, in which they were selling tulips at high, ridiculous prices, and people were buying because they were speculating. There is nothing wrong with speculating, but speculation is not for everyone. If you're going to be speculating, you have to know when to get in, when to get out, and you have to understand that a speculation is not an investment. A speculation is just a form of gambling. That is just what it is, because you know that there is no true intrinsic value in something, but you know that based on the hype, it can increase or spike in price, and that there is where speculation comes into being. Now let us move into number 7, business. People can also invest in business either by starting their own or by investing in an existing company, and not to mention people can also buy other person's business. So when persons get of age, they are no longer able to manage and coordinate the business structure that they already have established and formed over the years, and they have been running successfully. They have to put it aside. But sometimes there are many persons retiring, and these persons like to continue their business. They would want to sell the business because they cannot manage the business anymore. So there is an opportunity for you to go out and purchase a well-established business So all you do is get your team on the ground and allow them to manage and coordinate. Next kind of investment is the education that we pursue. Whatever course of study you decide to engage in, whether it is academia, vocation, whatever it is, there has to be an ROI. Do not do things which the crowd is doing, that after you finish it, there's no job for it, there's no market for it, there is nothing that you can do with it. I've seen many persons getting degrees and qualification which they cannot use to do anything in the real world. They don't really add value, but they went to college. And that there would be a waste, because there's no real reason for you to go and get yourself indebted and then you to have nothing to show for it. So we have to be mindful of our education, and not everything that is on sale you should pay for. Your time is another investment. Many people want to drain your time, drain your energy, take away your resources. Your time is precious. It is a limited resource. So whosoever you invest in, you pour in, you have to ensure that you are willing to give freely to them and know that you may never recoup whatever it is that you have given. And the time that has been invested can never be returned unto you. However, you will see the fruits of the watering over time. Then we have the emotionally investment. Some persons are just like emotional vampires. They drain you emotionally. They take away every single thing that you have within you. They make you feel as though it is a deficit that you are in. After you have had communication with them, after you have interacted with them, these people you have to be mindful and try to stay away from. Now, let's get back into the ROI. The ROI is simple. It is calculated by 1, dividing the profits or loss from an investment by the initial cost of the said investment, and then multiply that result by 100, because you want to understand the percentage of the investment. So ROI can be calculated by dividing the returns or gains on that investment by the cost of the investment. The higher the ROI, the better the rate of return, the better the investment. So when you are deciding which investment opportunity is best for you, you can use the ROI principle and technique to determine which would be a better deployment of your resources. If there is a loss in an investment, then the ROI is going to be negative. So that would be a waste of time, a waste of resources, and a loss in monetary value. For example, if you invest 100 in the stock market and it increases to a value of 110, the ROI on that would be calculated by 110 minus 100 divided by 100, and then you're going to multiply that by 10, and then that would give you a 10% profit in your investment. But on the other hand, if the stock decide to decrease to $90, your ROI would be calculated by 90 minus 100 divided by 100. Then you're going to times that by 100 for the percentage, and that would be a negative 10%. So understanding the ROI is important in personal finances as well, because it can help the individual to evaluate potential profitability of different investment opportunities and make informed decisions about where to allocate their money. I know that this has been an informative session, and I hope that you would have understood the concept of return on investment, and this would have given you guidance as to some of the things that you can consider to invest in. It is a hope that this knowledge that you have gained will be put to good use. Does it make sense, or does it make dollars? Signing out is yours truly. Have yourself a money-filled day.